This is the Growth and Value Podcast, empowering and inspiring stock investors, helping you take control and make a difference with your investment dollars. Looking for quality stock tips? Well, we may or may not be talking about Apple. We may or may not be talking about Google. We may or may not be talking about Disney. However, since we use our proprietary algorithms to screen, analyze, and rank over 6,000 stocks every week, we will be talking about timely investment opportunities. So you may often hear the name of a company you haven't heard of before, and you know what? That is often the best kind of opportunity, an opportunity to get in early before the investing masses. The Growth and Value Podcast is made possible by Connor Management Group, a registered investment advisor firm. Hi everyone, this is Maths Connor with Connor Management Group, and this week we're going to look at the best healthcare stock to buy right now. Today is Tuesday, March 4th, 2015, and here on the opening slide we see that this company is in the medical appliances and equipment industry, and we see its 6-month upside potential at 15.8%. That's one of the lowest numbers we've covered, say 15.8% over 6 months, which is still pretty good. But it looks like there are quite a few fairly priced names in the healthcare space, as well as quite a few overpriced names. So as we'll get to the next slide, we see this as the best healthcare stock to buy right now. And on the next slide, we see that the name of this company is called Stryker Corporation. The ticker symbol is SYK. And for some of you that have been following us for a while, Stryker does sound familiar. Stryker was covered about 6 months ago, and we are here again with the company after some nice appreciation since that original call. So we see its 6-month potential at 15.8%. On to the quick facts slide. Here's the business summary description. Stryker Corporation develops, manufactures, and markets orthopedic implants, medical surgery equipment, and neurotechnology and spine products. Orthopedic products include hip, knee, trauma, spinal, and other implants. So you can think of these guys as people that make the products for hip and knee implants. Their medical surgery group includes powered instruments, endoscopic systems, other operating room devices, specialty stretchers, and maternity beds. The ticker symbol is the website is www.strykercorp, that's STRYKER Corp.com. Stryker Corp is headquartered in Kalamazoo, Michigan. They were founded in 1941, and they have 26,000 employees. Onto the products and services slide. There really isn't too much to show. We've got the Stryker symbol, excerpts from one of their investor presentations, one excerpt saying developing breakthrough technologies, another advancing robotic arm assisted surgery, another one that says restoring blood flow, and another one that says helping patients get on their feet. I guess those are the high points on the products and services slide. On to the metrics slide. The annual revenue for Stryker over the last 12 months was $9.7 billion. They bring in quite a bit of revenue. Their net income over the last 12 months was $515 million, and the cash from operations was $1.8 billion. The operating margins for Stryker for 2014 was 24%, and in 2015, the operating margins is expected to increase to 29.0%. On to valuation metrics. The trailing PE ratio for Stryker right now is at 24.9, and its forward PE ratio is right now 19.2, and that implies that analysts expect earnings to continue to increase. The PEG ratio stands at 2.3. It's not necessarily at 1 or less, but not too high. The price to sales ratio is at 3.8. The price to book ratio is at 4.2, and the enterprise value to EBITDA ratio is at 13.6. The dividend yield for Stryker right now is at 1.5%. And the average dividend payout ratio over the last 5 years for Stryker has averaged out to be 33%. On to the price chart. Over the last 12 months, Stryker has increased 14%. The stock 12 months ago was around $81. It dipped to around $77, and from there it was kind of a somewhat steady increase to the $96 level today. Stryker so far had peaked out around $98 or so back in December. On to the next slide. The title of this slide is The Why Now, the bull rationale. And Stryker is expected to continue to increase in price, primarily because of increases in sales and revenues over the next 12 months, and also a low valuation metric is also expected with these increasing earnings, which puts pressure on the company for its stock price to increase. When you have a low valuation metric that's below normal, people will usually see it as a bargain, and that will push the stock price up. So, on to the summary slide. What we have here is that the financial statement quality for Stryker is excellent. Their debt is very well under control and small in proportion to their profits. The operating margin trend is increasing. As we mentioned, we see its operating margins increasing from around 24% in 2014 up to about 29% in 2015. The price pattern trend has been increasing. It's increased 15% over the last 12 months, and our overall market outlook is somewhat bearish. Stryker was really the only name in the healthcare sector that came up as a buy for us, and that's a bit unusual. And if anything, it just implies to us that most stocks in the healthcare sector right now are fairly priced, or they are overpriced. But Stryker is our best choice. The recent closing price for Stryker was $96.01, and our 6-month price target is at $110.51, and that gives Stryker a 6-month upside potential of 15.8%. So we've covered Stryker before, and it's basically come back up on our radar. Stryker's recently announced that they will start to do another buyback in the amount of $2 billion. Also, in some press releases today, they are not expected to make a acquisition of a company called Smith and Nephew in Great Britain. There was a lot of buzz about this a few months ago, but there was also buzz that the acquisition would not make sense financially. So I suppose that they backed away from that. But Stryker's business has increased and improved steadily over the past 12 months, and it's expected to do well with additional increases over the next year. So it's for all these reasons that we believe that Stryker Corporation is the best healthcare stock to buy right now. We hope you found this presentation helpful, and we'll talk to you again soon. Take care. Bye. Hi, this is Matthew Connor from Connor Management Group, and I just wanted to take a few more minutes to give you some background about myself and Connor Management Group. First of all, if you enjoyed this podcast, and I hope you did, and you have been over the past few months or so, please write us a review on iTunes and Stitcher. We really would appreciate it, and it would help us get more subscribers. So that's something we'd appreciate. So for the podcasters out there, please go to Stitcher or iTunes. And for you guys on YouTube, I'd appreciate a thumbs up and like, as well as just becoming a subscriber to the CMG Stock Picks channel. All right, well, that's what I wanted to say with regard to the podcast and YouTubers. Hey, try to be efficient. But I wanted to share a little bit about myself. Basically, I've been told from some friends and listeners that know me that I could enlighten my audience with a little bit more about myself. So I'm not all that comfortable with telling about myself. I really kind of want you to enjoy the content. But for those of you that have an interest, this is why this stuff is all the way at the end. So, okay. My name is George Mathis Connor. My background is that I have a bachelor's in mechanical engineering from a place called Rensselaer Polytechnic Institute, engineering school in upstate New York. A master's in engineering from Cornell University, also in mechanical engineering, and I have an MBA in finance from the University of Chicago. So hey, that takes care of my educational background. Basically, bottom line is to see, I did a lot of schooling. What my career experience has been to date. I started out my career as an engineer, did a few years of that. Worked on a lot of cool landmark renovation buildings in New York City for a few years. One of the most high-profile ones was my company, or I should say the company I worked for, was part of the renovation team of Grand Central Terminal. So for those of you that passed through there, I've spent a number of years in and out of every cranny of that building and facility. I also worked as a banker in New York after I got my MBA, and basically I worked on financing a lot of large-scale infrastructure projects, mostly power plants, but I worked on some basketball arenas as well, and some chemical plants, and even some coal mines. I've been deep down in the ground a number of times in my career. Additionally, let's see, after that, started working on the investment side of developing power plants, and particularly I spent most of my career with a company called Enron and another company called GDF Suez, where I worked on the development of power projects where where I acted as a equity investor for whether we were going to build them or buy them or sell them. And after GDF Suez, I am now an investment manager. And basically, I've been studying deals over the years, learning to build complex financial statements, always evaluating them, the cash flows, and making sure that these things will be profitable. And investing in the stock market was always a hobby of mine that I took more and more serious over the years. So after a bunch of time, I just, I'm really going to go after this. And so I spent maybe about, say, 3 years actually working on the development of some proprietary algorithms. I was just convinced that with my mathematics and computer background, coupled with all these financing deals, of which I became very good in with accounting and finance, I thought that I could at least find one way of consistently finding stock opportunities. So it was the development of these proprietary algorithms and me having some success with them that led me to the development of Content Management Group and the development of all of these videos and podcasts you've been seeing and hearing. And, I should say I am pretty happy with these algorithms. Basically, they review, analyze, and rank over 6,000 stocks every week. They're pretty comprehensive and pretty thorough. The algorithms use fundamental technical analysis and also consider some macro level measures. And another thing that's pretty unique is that these algorithms estimate future stock prices with specific time horizons. I haven't seen too many people on the web that will give you a potential stock price, say consistently say this is what we expect the price to be in 6 months, or this is the price that we expect there to be in 12 months. And I think for most of the videos and podcasts that I produce, you've always heard me give a potential stock price going 12 months out. The premium subscribers, actually give them a stock price for the top stock prices for 6 months out. So that's about what I have to say about the algorithms. Additionally, about Content Management Group, primary offering of CMG LLC is that we are a managed account service. And basically, a managed account, for those of you who don't know, is basically a more hands-on, customized way of investing for the long term. It's basically a complement or a supplement to 401k or IRA and it has more benefits. And basically, you probably haven't heard of these as much or over the years because they've just become a lot more available to middle-class investors. And that's primarily because of advances in software for being able to handle many clients and move them in and out of custom portfolios and options. So if you want to know more about our managed account business, please go to ConnorMG.com. That's www.connormg.com, or you could go to our website and you can see a presentation that compares Content Management Group side by side with other managed account providers. E-Trade provides managed account service, Fidelity does, a lot of other mainstream firms. And like we said, basically now that the technology is advanced with software, it's a lot easier to manage. So basically, as with E-Trades, the minimum size of account we open, say $25,000. And while as I'd say 10 years ago or more, minimum account size is probably $500,000. So there are a lot of changes, and you'll be hearing more and more about this account service, as time goes by. Additionally, let's see. Additionally, you can get to know us through our social media footprint. Basically, we have a presence on all the major websites for your convenience, and there you can get a lot more articles and hear about different points of view on things going on in the market. So we have a presence on Twitter, Google Plus, and Facebook, as well as LinkedIn also. So you can be kept abreast of our thinking on stock investing, as well as things we share by others who we consider thought leaders. And finally, CMG offers 2 newsletters, both weekly, 2 weekly newsletters. One is to keep investors up to date about relevant news and provide in-depth analyses on a quality investment opportunity. And those opportunities are consistent with the free weekly podcasts and videos. And the other newsletter we provide is our premium newsletter, and that one provides the latest top picks from our proprietary algorithms that we run every week. So, feel free to go to CMG stockpicks.com, and you can go there to subscribe to the newsletters. And if you go to the website, you can also view this deck and or any of the decks going forward, and there'll be a link there to everything I've just talked about. Basically, everything from the podcast to the newsletter to the presentations about our managed account service. So, hope this was helpful. Nice overview. Hope it didn't bore you. You can listen to this a couple times. That's why I put this at the end of the stock presentation. And I'll talk to you soon. Take care. Bye.